Hi, welcome back to the Lance Roberts Show. We're talking with David Zugheri from Morgan Rockwell, private lender today, talking about the real estate, the mortgage market, kind of banking in general. And in fact, speaking of banking, we were talking about the banks earlier that they've really cleaned up the quality of their balance sheets a lot over the last 10 years. Of course, they've had lots of government assistance along the way to help that process. But, you know, here we are, we're about to kick off this week, actually starting to see a lot of these big banks, the big major banks, report earnings. And, you know, we've seen the yield curve come down. And of course, the way banks make money is they borrow short and they lend long. But so that yield curve has now started to compress, and that's beginning to potentially weigh on earnings. What do you think?
Yeah, you know, you have these, the Wells Fargos and the Chases of the world that have a heavy mortgage concentration. I mean, they do a lot of loans, those two in particular. And the chances of them showing not taking it in the shorts on their mortgage division in the first quarter, zero. They're going to see a hit. When interest rates go up, it's very hard for mortgage operations to adjust. They always take operational hits. You can see, I'm sure, and I don't have the numbers in front of me, but I'm certain that Wells Fargo and Chase have both done layoffs. You just can't cut fast enough in order to keep up with the market.
Right.
You know, interest rates went up, I want to say year over year, maybe 50 basis points. We came from 4 to 4.5. You know, you've got the Fed that's saying we're going to continue to, you know, kind of push up a little bit. I think that number could hit 5 and stay at 5, right. which is fair. So the whole industry is just contracting, and that's okay. It's a cyclical business, and it'll take some time to readjust. Takeaway in the first quarter: expect for their earnings on the mortgage side to be down.
Right. And that would not be surprising. We've seen mortgage applications drop. Again, interest rates go up. Their income spreads are starting to compress here. So net interest income starting to compress here. So it wouldn't be surprising. You know, when we step out and we talk about, you know, the real estate market in general, the real estate market as a whole operates at the fringes. You know, the people that are sitting in their house every day don't have it on the market. They're not planning to buy or sell anytime soon. They're not moving the needle on the market. What moves the needle on house prices, et cetera, is the activity at the fringes, those buying and selling and creating supply and demand. And we saw interest rates come up, and having just sold my house just recently, it was interesting because buyers seem to be coming back into control of the market right now. Interest rates came up, valuations that had gotten a little bit extended here, and particularly when you start looking at states like California, Florida, et cetera, where valuations had really come up a lot. Starting to see those valuations come back, buyers really kind of regaining control over the negotiating process. Is this something that's likely to continue here?
You know, if we look at the Houston market, December of 17 to December of 18, active listings were up 13.3%.
Right.
It's a big number. Now, the months of inventory are still kind of in that 3 to 3.5 month range, which seems to be, I look at that and I go, that's balanced, that's about right. Okay. Whether or not it's turning to a buyer's market, I know people, as you being one of them yourself, yes, having a house on the market, it's like, man, it's just crickets out there. Now, right, definitely before Christmas, there were a lot of crickets. Right. Okay. Do we still hear crickets? The answer to that is yes. People are getting over the shock of interest rates going up a little bit. You know, if you're sitting on a 3.5% mortgage, how quickly do you want to run down, go get another house that's at 5? Yeah. It's gonna make you think twice. Yeah. And I think you're seeing a lot of that. Therein could lie the opportunity to go and as a buyer, you don't want to be there once everybody already figures it out. Right. You know, you don't. Wayne Gretzky said, "You don't go where the puck is. Right. You go where the puck is going to be." Right. And so the puck is going to eventually be a buyer's market, right, I think, and that gets me excited because, Lance, we hadn't seen this in 10 years. Yeah, it's been 10 years.
Well, you know, it's interesting. This is something you and I talked about coming out of the financial crisis. When I was doing my radio show back then, you were on the show, we actually talked about this very issue, which was, you know, the great thing about zero interest rates and ultra low mortgages is they're great for getting people into a house. The problem is ultimately going to be when rates come up, and you just said this, is that at some point people are going to say, well, I've got this 3.5% mortgage. I like my house. Okay. A lot of the housing market previous to 2008 was driven by people that were simply just continuing to upgrade homes. Mortgage rates would come down. Their value of their house was skyrocketing, so they would sell that house, take all that money they made on that house to buy a bigger house at a lower interest rate, and they'd have the same monthly payment.
Yeah.
Now, potentially, we're going to see that run into reverse, and that's got to have some type of long-term, more negative ramification to the housing market as we have traditionally known it.
Sure. Somebody at Chase had written a piece that I found very interesting, and this was in like 2010. So we're 2 years-ish into quantitative easing.
Sure. And
they called it the dark market. And the dark market looked like this. Interest rates were going up, inventories were going down, because inventory that has a 3%, 3.5%, 30-year fixed rate, they're not going to sell. They're not moving. So that's going to take a buyer and a seller out of the market. And, and back then it was like, oh goodness, here it comes. Well, how long was I wrong? I was wrong from 2010, because I subscribed to that. I believed in that. Yeah. And I was wrong for many, many years. Okay? I was really wrong around 2012 when rates kept going down and values kept going up.
Right.
Especially in the hyper-inflated areas like California and Arizona and Nevada, where the values had just been decimated.
Right.
People made a lot of money during that time. So I look now and I say, are we getting into that dark market?
Right.
And the answer is, yeah, but a little bit at a time. I mean,
Sure.
it's nothing that we can't overcome. It's just part of a healthy cycle.
Yeah, I guess my point is that for 30, 40 years, the housing market has really been a function of lower and lower rates, right? So people were so for 30 years the mortgage rate's been going steadily lower ever since 1980. We're now down to extremely low mortgage rates, where they really, even if rates don't go up, if we become Japan as an example, rates could just stay flat for a very long period of time. But the very nature of the fact that rates aren't going down, in other words, I can't get a cheaper mortgage to buy a higher value house and continue to upgrade, right?
Sure.
That may change the dynamic of what we have known as the real estate market in the next 30 or 40 years than what we've seen in the past 30 or 40 years.
Absolutely. I mean, and I'll tell you, it all starts with the concept of there just being a smaller market.
Right.
And instead of in Houston, selling 82,000 homes in a year, who knows, we might go to 79, and then the next year 75,000. And the markets will adjust. It's getting to that, it's the transition that hurts the most.
Right.
It's the real estate agents, it's the title companies, it's the mortgage lenders that have a hard time adjusting operationally to, oh my goodness, I usually do 100 transactions a month. Last month I did 75.
So what you're saying is that basically on Bravo Television, we might move from flip or flop to, hey, I just live here.
Yes. Yeah. I just wake up in the morning.
Come see my house. This is where I've lived.
Yeah. Welcome to my house. We're going to fix up the bathroom, one of the secondary bathrooms.
Maybe remodeling shows. That might be the new thing, right?
It could be. There's always, Lance, there's always going to be an insatiable appetite for people to go out and advertise, get rich quick, buy low, sell high. There's always going to be somebody out there that watches that, and I watch that because it's like watching a car crash. Some of these fix and flip is like, oh yeah, we bought this house and I did all this work for $40,000, which was really like $200,000 worth of work, but it doesn't fit the narrative. If you're Vanilla Ice, you got to make 300, 400, 500,000 when you flip out of it, and I go, dude, that is.
Hey, you know what? I'm so glad you said that, because my wife watches these shows and it's like, oh yeah, we're gonna remodel this whole kitchen for 10 grand. Look, right. I have remodeled shit in my house, and you can't remodel a door for 10 grand. Yeah. So that's all.
$10,000 is like, man, I thought that was just a refrigerator, but hey, this is Vanilla Ice. You got to go with it. What? How can you not believe Vanilla Ice?
Exactly.
Really?
We'll be right back on the Lance Roberts Show podcast with my friend David Zugheri from Morgan Rockwood Private Lender, right here on the Lance Roberts Show at our YouTube channel, Lance Roberts Show.
Want a longer talk with Lance about your money? Request a personal one-on-one at realinvestmentadvice.com.